or at whichever time you're watching this video clip. Welcome back to Management Accounting. Today we're going to look at cash budget and how to prepare a cash budget. We're going to look at an example of a cash budget and how to prepare one. Please, I'm going to ask you to pause the video at this time and write this information down. Pause the video, write this down for me, please. I'm coming back to this any at all. This clip. Pause the video. It says K&D Limited operates as a bookseller. On December 21, 2014, the summary statement of financial position, which is the balance sheet, was as follows, and you will see it here. And then the following transactions are anticipated for the next 3 months. You have credit sales, cash sales, credit purchase, cash purchase, and you have the different figures here. Right, so please, thank you very much. Now, here's some additional information for this question. Additionally, you are informed of the following: wages will be $250 per month. Postage and packaging will be 20% of credit sales and paid in the month of sale. Debtors normally pay 1 month after books are sold to them. Creditors are paid 1 month after receipt of books. Ship equipment will be replaced on January 1. The new equipment will cost $6,000. Payments will be made in equal installments in February, March, and April. The old equipment will realize $2,000 in February. Depreciation of new equipment will be 10% per annum and charge to the accounts monthly. Half of the dividends will be paid in March and half in July. Next, the company expects a gross profit of 33.3% on selling price. Now, we are required to prepare a cash budget for the 3 months ending March 31, 2015. It would have been February, should have been January. So we're going to create a cash budget now for January, February, and March. And also, we must forecast income statement for the 3 months ending March 31, 2005. Now, pause the video, write information down. So we're going to go now to the solution for this video. Alright, good, nice. As I go along, I will be coming back to this section. Get my point? Thank you. Pause the video, write something, please. Thank you very much. Now, this is a cash budget would look like, right? Alright. So, first thing is first, cash budget for 3 months ending March 31, 2015. Now, the receipts now. The first one says, we are told, first thing that debtors normally pay 1 month after books are sold to what? Them, right? Now, this credit sales of 3,750 is a money that was owed to you from what? December 31st, now 2014. Because if you look back to the balance sheet, you will see where debtors are 3,750. So, therefore, what happens here is that you collect the money 1 month after the book was issued or given to the person who bought the book. So, they paid in what? January. That's the 3,750 right here. Now, in January again, credit sales valued 3,750. That's why the collection of credit sales amount is 3,750 in what? February, because the credit sales in January was what? 3,750, and money is not collected until what? 1 month after. Alright. In March, the collection is 4,500 for credit sales. Why? Because credit sales for February was 4,500 and the money is collected when in March. Good. Cash sales now is 3,500. Now as well as the cash sales, that's just cash, right? Good. So cash sales is 3,500. That's based on what you given in the question for January, and 1,250 for what? February, and 3,000 for March. Good. Alright, now in the question, they said that the old equipment in section in part 5 under additional information said that the old equipment will realize at $2,000 in February. That's the reason why you have the sale of equipment for $2,000 here. All of these figures now, you get total receipts. Alright, for payments now, ready? For pay, for payments now, it said that first look at this credit what purchases, right? Say that creditors are paid 1 month after what receipt of books. Now credit purchases for December 31st, 2014 would have been $5,000 because on the balance sheet this is something called creditors 5,000. That's why the $5,000 is here, right? Because you got the books, but you pay 1 month. You pay the creator 1 month after you get the book. It should have been January, 1 month after. Good. For February, no 6,000 because what? In January, you got some book for value $6,000, but you know pay them until February $6,000. In February, you got some books valuing 5,750. So in March, you're gonna pay the 5,750, right? Cash purchases now, based on what we have on our question, is 500 for January, 250 for February, 250 for March. Good. Then you have wages now. Wages is what? 250 per month. 250 across the board, right? Good. Postage and packaging. It said that postage and packaging will be what? 20% of credit sales and paid in what? The month of sale. Now, so therefore, to get the postage and packaging for 750, it would have been 20% of the credit sale for January, and what you would do is to say 0.20 times 3,750, and like you 750, then 0.20 20% times 4,500, 900, then 20% times 5,000. And you get what? 1,000. Alright? Then installments on on shop equipment now. That comes from say that what is it now? Say that shop equipment will be replaced on January 1, right? The new equipment will cost $6,000 and will be paid in equal installments in February, March, and April. Now equal installment means how much? 3 months. You divide 6,000 by 3, you get what? 2,000. So you will start the payment in February, it is 2,000 for February and 2,000 for what? March. And it would have been 2,000 for April if you extended it. So therefore you divide the 6,000 by what? 3 to get the 3 equal installments. Um, Depreciation of the equipment, that part is not, will not, do not, doesn't go in the cash budget. That part will go where? In the income statement. Good? Alright, dividends now says section 7, additional information 7 says half of the dividends will be paid in what? March and half in July next. Of the next year. So half of the dividends will be paid when? March and half in July next. Now, if you go to the dividends though, if you go back to December 2014, you see proposed dividends of so what? 750. And what you're saying is that half of the 750 will be paid when in March. So you divide 750 now by 2, you get 375. So how you get that, right? Out of all of these now, you get the total payments. You're going to subtract total payments now from what? Total receipts. You get 750 for January. You subtract 9,400 from 7,000. You get there's one more thing I should remind you of though. Before going for sorry. So you get 750 right here, right? Then now you're gonna add the balance brought forward, meaning this now would have been the beginning balance. Follow me, please. This would have been the beginning balance from the previous year, and this would have been the cash at bank in the balance sheet. All right, it is 2,250. You follow me? This balance BD represents what? The beginning balance from the what? Previous period, which is 2,000. If you go back to your balance sheet, you will see the cash at bank of 2,250. So you're gonna add the beginning balance now to the what? Current situation or the current balance then, and that will give you 3,000. Good. This now is your ending balance for January, which should become your beginning balance for what? February. Notice that this format is different from the format I showed before. Alright? Now, for February now, it would have been 9,400 from September to give you 2,400 negative. Then you add what? Your beginning balance from your ending balance from January, you get what? $600. This now would have been your what? Beginning balance for what? March. And then your social 9625 from 7,500 get negative 2125. You're gonna add your beginning balance and you end up with a negative balance of 15,1,525. And that's about it for this section, for this part. Then now we're going to look at our this was the cash budget, alright? Good. Then now we're going to look at our income statement now. Alright. First thing is first, you have what? Sales, right? It's 21,000. Where did that come from, by the way? Hello? Where did that come from? Where did this sales figure come from? When the folks I'm talking to you. Alright. What is now? No. Alright, so for this 21,000 now, gentle folks. Now to get that figure, what you'd have to do is just add up the credit sales and the cash sales, but you'd have to go back to the original question on the first page. You have credit sales and you're gonna add all the credit sales and the cash sales. So you're gonna add all credit sales and the cash sales, and then you get the 21,000. Alright. Then now your less cost of goods sold, which is 66 and that. Alright. First thing is first. The question said that the company expects a what? Gross profit of what? 30% on selling price. That would mean of sales, right? That means that the company expects one third, our gross profit of one third of sales is 7,000. So the first thing you do is to write down the one third of 21,000, which is 7,000. Good. And remember now that to get your gross profit is really sales minus cost of sales. Now to get your cost of sales then, what does that mean what? Sales minus gross profit. And that's how you get the 14,000 right here. Alright? Which is naturally two-thirds of 21,000. Good? And that's how you get that right here. So the first thing you do is your gross profit first, and then you do the other calculation to calculate the cost of sales, right? Then now you have your less your wages is 750, postage and the packaging is 2,650. But how did you get all those, gentle folks? How did you get the 750 right there? What did you do to get that right away? You added all of the total. You total the 3 months. Can remember say anything, right? Total the 3 months, you get the 750. You total for postage and packaging, you total the 3 months again, you get 2,650. The depreciation of equipment now is said to be 10% per annum and charged to the accounts monthly. Should have been 10% of the equipment that was bought. Alright. And now the 150, first thing you have to find 10% of the equipment, which is six, would have been 600. Would be 10% of the equipment that was bought in January 1, which would have been $600. Now that 600 would have been for the what year? Now it is said that the depreciation is charged to accounts monthly. Good. Now if it's 600 for the year, what will be the monthly fee? You have to divide 600 now by what? 12. I get $50 per month. Now this is 3 months of the year, right? January, February, March. You have multiply the 50 by 3 to get the what? 150. Alright? Then you have loss on sale of equipment, which is 1,750. Why would that be the case? So the reason why, because the question said that the old equipment we realized $2,000 in what? February. Good. Now it is being sold at less than the value on the balance sheet in the previous year, which is 3,750, and that would be below what the price for it. That will give you 1,750. Out of all of these now, so you minus the 2,000 from the 3,750, you get one. So basically, I would have lost on the sale of the equipment of 1,750, and that gives you out of everything you get 5,300. Subtract, you get what? 1,700 what net profit, and that's all about it, folks. Thank you for watching. Look forward to the other videos coming up for the different for the other units.